This is a large and important section of the course, and it's also in Unit 2 as well. And if you do go on to A level, this will be a feature of the course. So it's really important that you get this area covered and you fully understand it. So it's legal structure, it's the way that a business sets up, and so we need to be able to describe the different forms of small business ownership. So we're looking at sole traders and partnerships, and explain the benefits and limitations of being a sole trader or a partnership. But then we have to look at slightly more formal or larger scales of business setup. So we're going to be looking at private limited companies and this process of incorporation and what is meant by limited liability, and the issues relating to them as well. Now, public limited companies, PLCs, are actually a Unit 2 topic, but I am going to bring it in this presentation because it's really useful when you're comparing an LTD and really understanding what it is if you can compare it to a PLC. So this is the legal structure in the UK of businesses. So we have the private sector, and then we have the public sector, which is run by the government. The private sector is run by private individuals, and this is really the unincorporated section is sole traders and partnerships. That's really what we're going to focus on with Unit 1, but you can get questions on LTDs in Unit 1, and these are incorporated businesses. Now, as you can see, LTDs, private limited company, not too difficult there, they're in the private sector, but we do get this section here, public limited companies, that students do get it mixed up with, and they start to think that that's in the public sector. It's not in the public sector. I'll explain later on why that has the name public limited company, but just as you can see here from this tree diagram, that it's actually in the private sector. So it's very important, this section, because the type of structure that you have as a business, the way that you set up, will determine how much risk the owner or owners have, how much tax or national insurance they're going to pay, so it affects their costs, whether they have to publish their accounts and the type of format that they have to publish them in, it's going to determine who's responsible for the business, what sources of finance are available to them, and who has control of the business and their ideas. Now, in this presentation, we'll cover most of those factors, but not all of them, and some of those questions will be answered in the other videos that we're looking at. So sources of finance, we'll cover that in the sources of finance topic when we look at that, because it makes more sense to cover it then. And records and accounts, we will briefly go over it here, but that will be covered when we're looking over finance and accounts and balance sheets, profit and loss accounts, in the other sections as well. So key terms here, debts / liabilities. This is money owed by the business, or when we're looking at liability, it's more a case of responsibility as well. The level of responsibility that the business has. So if we're looking at limited liability, what it means is that the owners can only lose what they've invested. So their responsibility is limited to the amount that they have invested. There should be some brackets on the end of there, sorry about that. Whereas unlimited liability, the owner is fully responsible for the debts of the business. So if the business goes into debt of 2 million, the owner has to pay that 2 million. And it doesn't matter if they own a house and they have a car and it's nothing to do with the business. The people that they owe the debts to will want that person to sell that house, sell that car, to pay them back. It doesn't matter that they haven't been used in the business activities. So there's a great level of risk that comes with having businesses that have unlimited liability, because you could actually lose the things that you own personally. So when we're looking at a sole trader, I always put this table up for my students because it's really interesting to kind of compare the different ways that they're set up. So in terms of how many owners it just has one, sole being, the word what, or just meaning one person. whereas a partnership can have 2 to 20. Now, in real life, partnerships actually can have a lot more than 20, but it always says this in GCSE textbooks and A-level textbooks, 2 to 20. So we'll just stick with that to keep it easy. And the owner, you'd usually just call them the owner if it's a sole trader or an entrepreneur. Maybe I've put a question mark there saying maybe that's what you'd call them. But with a partnership, they're called partners. The owners they've got a special name, they're called partners. Both of these structures have unlimited liability, so there's a lot of risk involved in opening up a sole trader or a partnership, and especially with a partnership, because if somebody else in the business, one of the other partners, is really risky and they take on a lot of debt, actually you're jointly responsible for that debt. So I always think partnerships are a little bit more risky than being a sole trader, because as a sole trader you should know what debt that you've taken on, whereas in a partnership somebody else, one of the other partners, could get you into trouble. And typically, the owner, the sole trader, will run the business, and the owners, who are the partners, will run the partnership. Now, this becomes more significant, and you'll realise why I've put that row in later on when we look at LTDs and PLCs. Now, I just want to draw your attention back to this thing here. Sole trader is one owner, but that doesn't mean that there's only one person in the business. There can be multiple people employed by that owner. So that's a very common mistake that students make when they're looking at this area. So benefits of being a sole trader: it is really easy to set up. It's probably under kind of £50 to set up, like the legal requirements to be a sole trader. I think you can go onto the government website and check out exactly what you need to do, but I'm pretty sure it's about under £50 to set up as a sole trader. And the owner has complete control of their own business because they're the only owner, and they get to keep all of the profit. However, there is unlimited liability. Raising finance is going to be usually a little bit more difficult. Usually sole traders are usually quite small businesses. Banks are not always willing to lend to small businesses because they might not trust that they'll get the money back. It might be that you've recently set up as well, so you don't have a track record of sales and revenue that they can rely on. And there's a lot of pressure on the owner as well, lastly, as a problem, because there's only one person. It's all reliant on them. One person at the top, I mean. There might be other employees, but they're the sole person in charge of the business. Whereas with a partnership, the workload can be shared. Partners can also introduce different forms of finance as well. So usually when you set up a partnership, if another partner wants to come in, they have to introduce more money to the business. So it's easier to raise money if there's a few of you there, because you obviously you've got more of your own savings that you can introduce. And there's a larger range of skills at the top between the partners. Now, with a sole trader, they can obviously employ other people, but with a partnership, you've got joint owners, and they can a range of skills that can bring in. One of them might be very good with the finances, one of them a little bit better with the marketing, and so on. Again, they have unlimited liability. Profits have to be shared, so they are partners. Whatever they make is going to be shared amongst them, and decisions can take longer because there's more people involved in the decision making. So, some more key terms now. These are the other two structures that you are going to learn about. LTDs are the one that feature in Unit 1 and Unit 2, whereas PLCs just feature in Unit 2. So just to break this down so you really understand, so private just means that only friends and family can buy the shares in this business. Limited means they've got limited liability, and company just means that they're owned by shareholders. Public limited company. Public means that anybody can buy shares in this business on the stock market. The shares will be sold on the stock market. Again, limited means limited liability, and company means that they're owned by shareholders. So if you break down the words like that, you really start to understand what it means. So incorporated is another term that goes along with these PLCs and LTDs, and it just means that the business exists legally. So here I've got a picture of an office block, just in my mind, that's representing a business, and then I've got a person, say the owner of the business. And incorporated just means that there's kind of a barrier between the two in terms of they exist legally, they're legally separate. Whereas if you had a partnership or a sole trader, the business actually doesn't exist in a legal sense. This incorporation or incorporated principle came about maybe 100, 150 years ago, and it just means that the business can actually be thought of as its own legal entity. It's a little bit like a person. It sort of exists in its own right. And I've put a picture of a house here because that's one of the biggest risks if you're setting up a business, that if you do own a house or anything of value, that if the business gets into debt or if it fails, your house can get taken off you. But if it's incorporated, it means that there's going to be limited liability, being limited responsibility of those debts, and it means that the owner is legally separate from the business. So if the business owes somebody £1 million, the owners can take whatever the business owns, but these personal assets are completely separate from the business. So you can't lose your house if you're a shareholder who's invested into an incorporated business, so an LTD or a PLC. So how many owners does the business have? Many. A huge number of shareholders that you can have. But with PLCs, I think actually there's a minimum of 7 that are needed, but usually a lot more than that, thousands. With LTDs, it's usually going to range from you could actually have an LTD just owned by one shareholder, I believe, but it's going to range from a few, 2, 3, 4, up to probably, I don't know, like something like 50. So there's going to be fewer usually than with a PLC. The owners are called shareholders. They have limited liability, both of them. But it is directors that run the business. So this is where we get what we call, between that and that, we get this divorce of ownership and control. So the benefits of, it should say LTD and PLC above there, but the benefits of an LTD is limited liability. It's more trusted by businesses as well, because actually to become an LTD, you have to meet a lot of legal requirements, and so therefore the banks might trust you a little bit more, suppliers might trust you a little bit more, because they know you've gone through this incorporated process that you need to go through, and so that someone's going to be looked over your accounts, and you have to meet certain requirements. And again, there's going to be a new form of finance that's open to you, which is being able to sell shares, which obviously wasn't open to the sole trader or the partnership. However, because you do have to go through all these legal requirements with Companies House, it is going to be more expensive than setting up a sole trader or a partnership, and you do have to publish your accounts. So all of your competitors can find out how much money, how much revenue, how much profit, how much your costs were as well. PLC, again, limited liability. They can raise large amounts of money through selling shares on a stock market, so they can actually raise even more money than an LTD by selling shares, because they can sell them publicly through the stock market, so there's more people to be able to sell them to, so they can reach a wider market. However, it's really expensive to set up, much more than even an LTD, and you have to go through certain requirements, and they're much stricter requirements to be able to sell on a stock market. You can lose control of the business if somebody buys the majority of the shares, so 51% of those shares, and there's what we call divorce of ownership and control. So divorce of ownership and control basically means that the shareholders, the owners, don't typically tend to run the business. It's usually the managers who run the business. Now, these may or may not be shareholders, but they might not always act in the interests of the owners. We look at this in economics, actually, and we look at, the managers might just want kind of large bonuses and they want an easy life, whereas the shareholders want to usually maximize profit. So that's where their interests might be a little bit different to each other. Now, if I just go back to this one, I can say that, theoretically you could have divorce of ownership and control in both of these structures, but actually with LTDs it's quite likely that these directors are actually shareholders themselves, and usually quite big shareholders as well. So it's less likely to happen with an LTD than it does happen with PLCs, where there's just going to be hundreds of shareholders, and they can't possibly, all be managers or taking an active role in managing the business.